Hey, this is Yussi. I run a small investment firm that specializes in REIT investing, and in today's video I want to discuss different types of REITs that you should be avoiding. This is a vast and versatile sector with over 200 companies in the US alone and 1,000 companies worldwide, and let's face it, not all of these REITs are worth buying. On the contrary, this is a sector in which you want to be very selective because there are very wide discrepancies in performance from one REIT to another, and a great example that I like to use is the case of Global Net Lease versus Agri Realty, because both are net lease REITs, they invest in the same property sector, and yet their performances have been day and night since they've gone public. If you had invested in Global Net Lease, you would have lost a lot of money, and yet if you had invested in Agri Realty, you have done really well over time. At High Yield Landlord, which is my REIT newsletter, we only invest in one REIT out of 10 on average, and so this implies that we're very selective. There are a lot of different types of REITs that we are avoiding, and in today's video I want to discuss 5 of the worst type of REITs that you should avoid. But before I get into it, I want to let you know that we just recently launched our Substack. There's a bunch of free research there on some of our top picks. I'll put a link to it in the description of this video. And if you want to take your REIT investing to the next level, you can also join our paid newsletter for a 2-week free trial. You will gain immediate access to my entire portfolio and all my top picks for the second half of this year. So the first type of REIT that I'm avoiding is mortgage REITs. Typically, REITs are divided in 2 main categories. There are equity REITs and mortgage REITs. And equity REITs are those that own properties, so these are typical landlords. And the vast majority of REITs would classify as equity REITs, but there is also a small subcategory of REITs that we refer as mortgage REITs, and these are REITs that lend money to other property investors and also invest in real estate securities. These mortgage REITs are typically very popular among individual investors because they tend to offer much higher dividend yields than equity REITs. It's not uncommon to find mortgage REITs offering an 8, 9 or even a 10% dividend yield, and some popular examples that come to my mind include Arbor Realty Trust, KKR Real Estate Finance, Blackstone Mortgage Trust, Starwood Mortgage Trust is one of the most popular. But despite offering these very high dividend yields, they've actually done very poorly on a total return basis over the years. I'll put a chart on the screen where you'll see that over the past 20 years, mortgage REITs have only delivered roughly 2% average annual total returns, which is very disappointing, obviously. And the reason why they've performed so poorly is because they're typically over-leveraged. They're also externally managed, which leads to a lot of conflicts of interest. And the biggest issue of all is that their business models are highly dependent on macro factors that are out of their control, like interest rates, spreads, and other macro factors that are just very difficult to predict. And these REITs have consistently failed to predict the big turns in these macro factors like the level of interest rates, and because of that they've paid the price, and most of them have seen their share prices decline over the years. And so there's no point in earning a 10% dividend yield if that's matched then with an 8% annual decline in your share price that leaves you just with 2% average annual total returns. And that's why I'm avoiding mortgage REITs. I just don't like the business model. I don't want to be so dependent on macro factors that are difficult to predict. I also don't like the over leverage, the external management structures, but I'm not against necessarily investing in the preferred shares of mortgage REITs. In fact, we own some at High Yield Landlord. An example is the preferred shares of KKR Real Estate Finance. We own a stake in them. They've done quite well for us over time. They're offering an 8% dividend yield. They're still priced at a pretty steep discount to their par value, so there's some upside potential. Well, they've already re-rated some now over the past few weeks because the company delivered strong second quarter results, but even then I still think that they remain relatively attractive, and I like to be invested in the preferred equity because it gives us a better margin of safety and we are much better protected from the risks that the common shareholders are facing. Hey, before I go into the second type of REIT to avoid, can you please do me a huge favor and click the like button? That will help me a lot to keep growing this channel. Thank you so much in advance. Then the second type of REIT that I'm avoiding, and I already alluded that in previous discussions, is that of externally managed REITs. Here you need to know that there are really 2 main types of management structures. REITs can be internally managed or externally managed, and today most REITs are internally managed. What this means is that the management is hired as employees of the REIT. They earn salaries for taking care of their management. Typically their compensation structure are tied to some key performance indicators like the growth of FFO on the per share basis, the dividend per share, the total returns that shareholders are enjoying over time, perhaps on a 3-year trailing basis. And so this does a good job at aligning the interests of the manager and the shareholder. Typically the manager will also only work for the REIT, so they won't be managing some other separate fund on the side. And so again, it does a really good job at mitigating potential conflicts of interest, and this tends to boost performance over time. However, there's a minority of REITs that are still managed externally, and what this means is that the management is outsourced to an external asset management company. A good example here would be Blackstone Mortgage Trust, which is outsourcing its management to Blackstone. And I'm not necessarily saying that it's a big problem in the case of Blackstone Mortgage Trust, but it does lead to conflicts of interest because Blackstone is going to earn a fee income for managing Blackstone Mortgage Trust. And so you need to look at how these fees are structured. Typically, they will include an asset management fee that's based on the volume of assets under management. Then there may also be an incentive fee based on the total returns over time. It might be past a certain benchmark, they're taking a profit split. There might be some acquisition fees, some development fees, some disposition fees, and so on. All of these different fees lead to conflicts of interest because let's say if you're now an asset manager and you're rewarding based on the volume of assets under management, this is obviously going to incentivize you to issue a lot of equity in the markets, even if it's dilutive, because then you can buy more properties, grow the size of the portfolio, which leads to higher fee income for you. It will also allow you to generate those acquisition fees. Maybe if you're earning disposition fees, you may also be more tempted to trade in and out of properties. So even if a property is just fine to be held for the long run, you may decide to sell it to get those fees, then acquire another property to again get some fees. If you're getting incentive fees, you may be willing to take more risks, so higher leverage to have a better chance of getting above that benchmark. And so, but in short, yeah, there are much greater conflicts of interest in the case of externally managed REITs. And the best example of this is perhaps the case of Prologis, which is a blue chip internally managed REIT, versus the returns of Industrial Logistics Properties Trust, which is a lower quality externally managed REITs, which has faced a lot of issues over the years, in big part in my opinion because externally managed. I'll put a chart on the screen and you can to compare their performance, and you'll see there that Prologis has done really well over the years. It has doubled your money over the past 5 years or so, and that's despite the recent REIT bear market. On the flip side, if you had invested in Industrial Logistics Properties Trust, you will have lost almost everything, and this is because again, in my opinion, because of these conflicts of interest, the management was consistently issuing more shares at dilutive prices. It was also using too much leverage. It closed a massive acquisition at a very inopportune time, and because of that, the company is now potentially on the verge of bankruptcy. And it's not just this one REIT. On average, if we look at the performance of externally managed REITs versus internally managed ones, you'll see that internally managed REITs have done a lot better over time, and that's despite also being safer on average. And so I just tend to stay away from externally managed REITs. The only exception would be, again, if it's investing in the preferred shares. I think that those are better protected from these conflicts of interest, but generally speaking, I just avoid all these REITs. Then the third category of REITs that I tend to avoid is those that are over-leveraged. And, a lot of REIT investors like to invest in REITs that use a lot of leverage, thinking that, yes, it will lead to volatility, but also higher returns over time, and that this trade-off is worthwhile. But based on my experience, the more conservatively financed REITs have actually more often than not outperformed the aggressively financed REITs over the long run. And there is actually a good explanation for this, because there's no point in earning very good returns during a bull market by using a lot of leverage if you then lose it all or a big chunk of it as soon as you hit a crisis. And unfortunately, that's what has happened to a lot of these aggressively financed REITs that have LTVs above 60% or even 70%. They tend to do really well during the good years, but then they lose so much of it at the first sign of a black swan, like the great financial crisis, the pandemic, the recent surge in interest rates. And it might be great to earn 20% average annual total returns for 5 years, but if you then go bankrupt when there's a crisis and you multiply that with zero, in the end you're still left with zero. And based on my experience, it's much better to invest in these more conservatively financed REITs that have a 30, 40, perhaps 50% LTV depending on the property sector. They don't earn quite as high of returns during the best years, but they have less to lose when you hit a crisis. And on top of that, and this is very important, they are also then able to buy properties from these distressed sellers during times of crisis at very low prices, and so this then boosts their returns in the eventual recovery. Moreover, the interesting thing here is that, remember, the REIT market is not always perfectly efficient, and because of that, there are some unique cases where the conservatively financed REIT may not be any more expensive than the aggressively financed REIT, or in some cases maybe even cheaper than the aggressively financed REIT. And a good example here would be the case of New Lake Capital Partners versus Innovative Industrial Properties Trust. These are both cannabis REITs, but the key difference is that New Lake Capital Partners has zero debt on its balance sheet. In my opinion, its properties are slightly superior in quality quality. I expect the REIT to enjoy better growth prospects over time, and despite all of this, it's actually priced at a discount relative to Innovative Properties Trust. And I think the main reason for this is simply because NewLake Capital's Partners is much smaller, it's not as popular, it's not Innovative Properties Trust is much better known than NewLake Capital Partners, but simply based on the fundamentals, I prefer the case of NewLake Capital Partners, and especially so because it has much less leverage. Then the fourth type of REIT that I would avoid are those that are excessively large, because size has some advantages. I'm sure you know this. It brings economies of scale in your management. It also gives you better relationships with your tenants, with your lenders. It has many advantages, I'm not denying that. However, I think that past a certain point, size can become a disadvantage. It can lead to diseconomies of scale, and because you need to remember that REITs really grow in three primary ways. The first one is by growing their same property NOI, so growing their rents, growing their occupancy rate, and so on, lowering their property cost. The second type is by simply reinvesting their retained earnings into more properties. And then the third one is that of spread investing. And what spread investing is when you are raising more equity as well as debt and then reinvesting it in more properties and doing it at a positive spread. So you're hoping that your cost of capital is lower than the cap rates of your properties. And if that's the case, then you can raise a lot of capital, buy a lot of properties. And if you earn a positive spread, then this expands your FFO on a per share basis as well as your dividend on a per share basis. However, if your REIT is very big in size, let's say the case of Realty Income, I've often discussed that one on my channel. It owns over 50 billion worth of property, and so to grow here with spread investing will be quite difficult because the company would need to raise such a huge volume of capital and invest it in so many properties at once for really it to move the needle. It becomes much more complicated versus a smaller net lease REIT like AgriRealty, which doesn't have to buy nearly as many properties to keep on growing. And this is well reflected in the past performance of Realty Income versus AgriRealty. If we look now at their past 10 years, I'll put a chart on the screen, you'll see there that AgriRealty has done far better than Realty Income. And that's really ever since Realty Income's size has become a bit of an issue and has slowed down its growth. And the interesting thing here is that if you go then further back 20, 30 years, in that case, Realty Income has done actually better than AgriRealty. And that's because back then its size wasn't an issue and the REIT was able to grow at a rapid pace. But again, the fact that it's done so much worse over the past 10 years, I think is a great evidence that size can be a disadvantage in the REIT sector. And then fifth and finally, there are a lot of different property sectors that I'm also avoiding because, REITs today invest in 20 different property types, and this includes even exotic things like timberland, farmland, cell towers, data centers, billboards. There were a few prison REITs also back in the day. They're really all types of REITs, and I don't think that all these property types are worth investing in. It of course depends on the time. There are times when a given property sector may be oversupplied, but then the same property sector may 5 years later be undersupplied and heavily discounted. So it also depends on the time when you invest. But generally speaking, there are 4 different types of property sectors that I'm avoiding today as of right now. The first one is that of hotels. It's a very cyclical property sector. It requires a lot of capex. There's growing competition from Airbnb, but also different booking websites. There's also the issue that following the pandemic, people have now learned to use Zoom and other teleconferencing software, and because of that, business travel hasn't fully recovered, and I don't expect it to recover over the coming years. And so there is some oversupply because of this, especially for hotels that rely heavily on business travel in downtown districts. Despite all of this, I don't think that these REITs are particularly cheap today, and for this reason I'm avoiding them. The second property sector is that of offices. I think that hybrid work settings are here to stay. This is leading to less demand for office space. I think that tenants are going to hold a lot of bargaining power with landlords of the coming years because vacancy rates are today at a 20-year high. This means that office landlords are going to have to very heavily reinvest in their properties, give very big tenant improvement packages, and I expect cap rates to expand. Take all of this into account, office rates actually aren't as cheap as they may seem to be. Yes, they've crashed, but I think that this crash is warranted in this specific case. Then the third property type that I'm avoiding is that of self-storage. To be clear, I'm not fully avoiding it. I think that there are some specific countries in which self-storage is very attractive, and I'm investing in a self-storage REIT in Canada, one in Australia, one in Europe as well. However, here I'm referring to American self-storage REITs like Public Storage, Extra Space Storage, National Storage Affiliates. I'm avoiding these REITs because I think that the American market is going to be oversupplied for years. Today there is 10 square foot per capita of storage space in the US. US, but only one in Europe. And sure, there are some cultural differences and demographic differences also that warrant there being more storage space per capita in the US, but still, I think that the difference is too big. We've built storage facilities all over the place in the US, and I think that this is going to lead to weakening fundamentals over the years, especially as people like to spend more and more on experiences over things. And on top of that, the sharing economy also keeps on growing. 10 years ago, people would buy their own RVs, their jet skis and so on, but if you can now very easily rent those at an affordable cost, you may not be as likely to buy these toys. And I think that these different trends are going to hurt the self-storage space over the long run, despite that these REITs are still relatively expensive today. And then the fourth property sector that I'm avoiding is that of gas station. I think that the transition to EVs, so electric vehicles, over the coming decades is going to hurt their valuations because, if you own an electric vehicle, you're much more likely to charge it at home, or if you're traveling a longer distance, you might be more willing to charge it while going to the restaurant because you'll spend a lot of time there anyways, whereas the convenience store format doesn't work so well for it. I think that a lot of gas stations obviously are here to stay and will do well in transitioning for electric vehicles, but I think that this sector is going to become heavily oversupplied because, again, most people will simply charge their car overnight at home. They won't visit gas stations nearly as much anymore, and so they're going to have to redevelop into other uses. But the problem here is that it's very expensive, and secondly, there are ecological risks when you do this because you tear down a gas station to build something new on top of it. Maybe a few years down the line you find that there were some leaks. You may have to then tear down whatever you built on top of it. It's a very big risk, a liability risk in fact. And so despite that, the few REITs that specialize in gas stations aren't cheaper than their close peers that own better properties, in my opinion, and for this reason I'm avoiding this sector. But to be clear, just because I avoid these different types of REITs, so mortgage REITs, externally managed REITs, over-leveraged REITs, those that are excessively big, and these different property sectors, doesn't mean that I'm bearish on the REIT sector. On the contrary, I'm very bullish today. In fact, I have about 50% of my portfolio invested in them because they are priced at their historically low valuations. They crashed because of the surge in interest rates, but now I expect them to recover strongly over the coming years as interest rates are gradually cut to lower levels. And so I'm actually more bullish than I've been in many years, and I'm very heavily investing in this space. But the point that I'm trying to make in this video is that you need to be very selective when you invest in this space, because just because two REITs share the same acronym doesn't mean that they have anything in common. One REIT may do really well over time and the other one may lose all of your money. So you need to be very selective. And if you want to access my entire real money REIT portfolio, these are REITs that I've closely vetted myself. You can join my REIT newsletter, High Yield Landlord, for a 2-week free trial. This will give you immediate access. Oh, I'm cutting this for a second just to show you this. Look, there's a reindeer. I'm currently in Lapland in Finland on holidays with my family, and there are reindeer everywhere. But I was saying that, yeah, if you want to join my REIT newsletter, there's a 2-week free trial, meaning you won't be charged anything in the first 14 days. Even then, you'll still have access to my entire portfolio, all my research, all my top picks for the second half of the year. This really shows you how confident we are in our newsletter. We allow you to join at no cost, see what it is about, and if it's not for you, you can cancel, no problem. There's also a $100 discount for the first 100 members to join our offer on Substack, which we just launched a week ago. If you enjoyed this video, please click the like button, subscribe to the channel. Also, leave any question down below and I'll make sure to respond to you. Thank you so much, and see you at my next one. Bye-bye.